Today, we will discuss how will rising CPI and dollar index impact the equity markets, NSE Indices outlook, and strike data analytics. Hello, everyone. This is Shilpa Raidas. Welcome to Midweek with Indiacharts, and we all welcome you, Jay.
Hi, how are you?
I am very good, Jay. How are you doing?
All fine, all fine.
Very
Thanks.
nice. So, Jay, let's quickly begin. We are very excited to hear your analysis today. So, what we've been seeing is slightly higher CPI led to a sharp sell-off in the US indices, right? And it also led to a spike in the dollar index. What does this mean to the equity markets in general, Jay? And what should we expect going forward?
Yeah. So one thing, yesterday it triggered like a key. It triggered a sell-off in the US indices because the CPI data was above the expectation. So all this while we had been discussing in the midweek as well that the expectation that the market was factoring in was of 6 rate cuts in this year. Okay. And with the Fed's commentary, it was more or less very clear that those 6 cuts are not going to come by. And in fact, yesterday's CPI data was a reaffirmation of that. And now what the market should probably pencil in is 3 rate cuts or 4 rate cuts. Okay. That is what seems like a very possible scenario. Now, obviously, Fed is going to come in March and they will guide the market. And that would be the most important point. But right now, I think the correction that we saw in the US indices was more to do with the expectation mismatch which was there of higher rate cuts. Those are getting corrected. And that's about it. I don't think there is much to read in that because, Fed has clearly stated that, it is seeing the data going its way. It's just that it needs more confirmation to see those data. Now, they are not in a hurry ke, matlab data aa gaya to, they'll start cutting the rates. They need that data sustainability to be there. Okay. That CPI cooling of sustainability should be there. And that's where I think they will start reacting on the rates, because one thing they are very sure about is that once they want to cut the rate, once they do the rate cut, they don't want to go back and, end up raising the rates and so on and so forth. They are okay to keep it higher for longer. As long as eventually when the rate cutting comes, they will, go all out for that and basically go towards their stated objective. That is of 2% inflation. Keeping that in mind, they will adjust the rates. And that's about it. But yes, one interesting thing that has happened yesterday. So let me share my screen and share with you the chart of the dollar index. So yeah, if you see the dollar index, if you see, there was a very big spike yesterday that we saw, and with that, it has now retraced 61.8% of the entire decline. Okay, so we had mentioned this that in the monthly chart, if we go, it was taking the support of the 40-month and it was moving higher, right? So now with the retracement, the dollar index has come back towards the 61.8% retracement mark. Now, one thing to note is that if the 61.8% mark is broken and the dollar index sustains above that, then one cannot rule out the possibility of a rise higher towards this trend line, which will which can make it as A, B, C, D, E. Okay, so that is something that risk will open up. And in fact, the bullish argument for the dollar index can be that this entire correction that we have seen in the dollar index, okay, this entire correction is possibly done. And this could also mean a start of a big up move as well. Those are the bullish scenario right now. But anyway, see, in either case, like I discussed, if the 61.8% retracement mark gets broken on the upside and it continues to sustain above that, then it means that we are possible. There is a risk that we could be headed higher towards 108 as well. Okay. So at 108, figure out, whether the up move is getting over and we are going to get a decline, or there is much more up move that is left. Okay. So we'll figure out at that point of time. But yes, definitely I mean, if you see the US indices, I mean, it was on steroids. It is still on steroids. It is not holding. I mean, it is not coming down at all. In fact, it is rising higher. It was only yesterday where we saw some sort of panic kicking in the US markets. So again, like we have been doing for the Nifty indices and other indices as well, we will wait for the averages to break on the downside. Okay. It's basically from a medium term perspective, the blue line, which is the 40-day exponential average. If that breaks, then yes, there could be trouble for the Nifty, I mean, for the US indices, which again will be a trouble for everyone, because, if the mother market, which is the US market, if it does not do well, then usually it has an impact overall on the equities. And one
Right.
thing to also note is that there is a bearish crossover now that we are seeing in the S&P index. So that's why, remember that, the cycle over here was not complete. I mean, it did not come back towards the zero line and it started rising higher. So if the 20-day breaks on a closing basis and S&P sustains below that, then ideally, you would expect the cycle to get complete, and which will probably put pressure in the near term. Okay. Now, what we are actually seeing is that there is a lot of divergence within the US indices, right? I mean, we spoke about it in length in the last, midweek, which we recorded. So I'm just, refreshing that once again. Basically, see, if you see over here, S&P 500 is actually way lower than its all-time high, right? Which it had made in 2022. And similarly, if you basically see the Dow Jones Transportation, it has neither made a new high as well. I mean, even that topped out around in 2021. And even in this high, I mean, it is not able to break past the previous high as well. But at the same time, Dow Jones has been rallying higher and it has broken past the previous high. So all, these things are indicating that there is a massive divergence that is there in the US indices. Okay. And that is something that, one really needs to take care. So that's where I think the averages which we spoke about, those will be very important to watch out for. And also, if that breaks on the downside, then in a broader term, what it would mean is that this entire move is actually corrective. Okay, which means that there is a risk of a deeper correction that can kick in. Okay, probably,
Okay.
you can see that 20-30% kind of decline as well. That's the setup we are in. Okay. Now, whether it happens, it doesn't happen, how does it happen, what time does it take? Those all are things that we will see. But as of now, that is the risk that is on the table. So mind you, if the averages get broken on the downside, one needs to be very careful, because like we have highlighted yesterday, I mean, in the past week, that there is a lot of intermarket divergence that is there in the US indices. And if those all come true, and also if dollar index, sustains above that 61.8% mark, which is where it is right now, like 104.80 or something is the 61.8% retracement level. So if that breaks and the dollar index sustains above that, then it could put pressure on the equity market, and it may not be a good scenario for either for the US indices or for the global markets as well. So these are some of the risks that we have in the horizon right now, and we have to see how things unfold.
Okay. So Jay, considering all these factors, what's the outlook on the key NSE indices then?
Yeah. So again, one important thing is that the Nifty index so far, I mean, it has really tested the patience, and it has been basically choppy over here. Like you see, I mean, since past almost 1.5 month, it is basically chopping around in this range only. And neither are we seeing a breakout nor are we seeing a breakdown. Okay.
Right.
So then when we see the lower time frame, or when we see the structure of the Nifty index, basically, similar to what we spoke for the S&P index as well, the blue line, which is the 40-day exponential average, that needs to be broken on the downside. Okay, which I think has now moved higher to somewhere around 21,490 levels. Okay. If that breaks on the downside, then that's where I think, a meaningful correction of this up move should kick in. Okay, which should result into, multi weeks of correction as well ahead of us. If we see the small and the mid cap index, actually they have behaved the way, we had anticipated, which means that there was a sharp decline as well in the small mid caps. And so far it is holding the 40-day exponential average, which is the blue line. So typically, see, what happens is that when the major support levels are tested, within the first go, it is difficult to break. Okay, so there will always some support that will emerge. But I think on the pullbacks, this should witness selling pressure. So in this case, I mean, if I have to go to the hourly chart basically to see the retracement. So if I do the retracement of that, so far it has done 50%. It has a scope to do 61.8%. Okay, but I think once that is done, it should resume its next leg on the downside, because this fall on the hourly chart looks like an impulse, because this is 9-leg decline. So which is basically an impulse. So there is a 3-way pullback that we are seeing. Once the pullback is done, probably I would expect the next leg of the decline to unfold. Okay. Now, basically for the Nifty index, if we see, I mean, it is getting a little complicated. So firstly, if I go by the simple technical factors, so if I draw this channel, okay, so the Nifty index bounced back from the lower end of the channel, and it is now back towards the upper end of the channel. Okay.
Right.
So I expect that if this is not broken, and also see, we are considering a 5-wave decline from this top, okay, which was formed on 24th Feb. So even if we go by the retracement level, the 61.8% retracement level was somewhere around 21,850. So even that has been tested today. Okay. So Nifty right now is sitting at a major resistance. And I would think that if this resistance has to be broken on the upside, okay, then the possible outcome that, we are thinking of is that this ends up becoming, some sort of distribution triangle, where basically this becomes A, B, C, D, E. Okay. And once this distribution triangle is complete, only then it declines. So obviously, this is not a preferred case. Okay. In fact, we think that somewhere around this top, the Nifty stop is done. Okay. And we are headed lower. But yes, I mean, if the resistance level breaks on the upside, then one needs to be open for an up move towards 22,000 or 22,100 to complete then that final leg on the upside. So that is what our case. So frankly, Nifty is kind of testing our patience, and we are not getting those follow through. Because when we look at the daily chart, I mean, it is almost impossible to trade the Nifty index, because we are getting 1 day up, 1 day down, 1 day up, 1 day down, and so on. I mean, those are the patterns that we are getting. Okay. So I would expect that maybe once the US indices also they start falling, that's where maybe the momentum in the Indian markets may also pick up. But we'll discuss about the strike data in the last part. And that's where I will show you that how the setup is over there. And the kind of setup which is there is not good. Okay. So ideally, we would expect a correction to unfold. But like I said, the blue line is, kind of behaving like a Lakshman Rekha right now. Okay. So this blue line needs to break on the downside, which is right now at 21,490. Once that is broken, I think that's where the momentum should pick up on the downside. So broadly, in the small mid caps, I think the top is done. Okay, what we are seeing right now is a retracement. Once the retracement is complete, we should be, these indices should be headed lower. I mean, this was for the mid cap, and even for the small cap, it is similar to this. So the blue line, the 40-day exponential average, that got held. We are seeing a pullback. I think once the pullback is done, we should be headed lower, even on the small cap index. It is actually the bank Nifty index, which is, which is sitting at the edge, because when we do the weekly chart, so on the weekly chart, the blue line, which is the 40-week average, that is where the bank Nifty index is taking support. Okay. So there is some doubt in bank Nifty, whether it is going to do a pullback of this decline or it is going to form an ABC. So the preferred case is that the pullback that we have seen in the bank Nifty, that is done over here. This is an impulse decline on the hourly chart. This is the pullback that we have seen right now. And somewhere over here, probably from tomorrow, it should be headed lower. Okay. If at all, it sustains above the 61.8% mark, which is at 46,020. Okay. If it closes above that and sustains above that, in fact, one can also take a reference of the 40-day exponential average, which is at 46,075. If that is not surpassed on the upside, okay, on a closing basis, then I think we should top out somewhere over here. I mean, this pullback should be completed somewhere over here, and it should head lower in the days to come. So we are at an interesting point, because if the reversal has to happen, it has to happen from somewhere around these levels. Say if for some reason, tomorrow the market remains flat, and even say on the next day, the market remains flat, then there is a risk will open up of a deeper correction. Like I mentioned, in which case bank Nifty can also end up doing something like this, and it will do a larger retracement, in which case wave B or X, which we were anticipating, which has completed over here, that may end up completing somewhere over here. That would not basically change the larger picture of it going down. It is only that, we are just trying to fine tune where the pullback ends. Has it ended over here or does it end over here? So yes, broadly, that's how the setup is. A pullback is on the way and it should be done. We need to see a follow-up on the downside, and blue line, that is the 40-day exponential average, that needs to be broken on the various indices.
Okay. So Jay, what are the data points on strike telling you right now?
Yeah. So now, this should be interesting because there are many factors now, which are pointing out towards weakness. So one is the DII future. So increasingly, DIIs have become an important participant in the futures market. So when you see the DIIs positioning, whenever it comes towards the first or the second line, as you can see, there is like a correction that we see in the Nifty index. Okay. So see the data, especially after 2018, basically after this, I mean, over here, it touched the first line. We saw a correction. Okay. Over here, it was in between the first, second line. It saw a correction. Okay. Over here, basically, this was the point. In fact, when it had touched over here, it went through a sideways sort of phase over here. Basically, over here, did not see much correction, but it was a time-wise correction. But rest of the cases, like you see over here, it was a top. Okay. In 2021, I mean, this went towards the extreme level of, say, somewhere around 90,000 or so, and that actually led to a major top in the market. And that's where after that, that Ukraine-Russia war and all took place, and the Nifty index was heading lower. So that's where even over here there was a top. Okay, and now we see that the positioning, that is the short peaked over here, and the market so far, I mean, is around the highs. Okay, it has not corrected, but on an average where we were looking at the declines, okay, it was somewhere between 7 to 10% was the decline that the Nifty index had seen whenever this reading had gone to around minus 40,000 mark of the DII's, net position in the index futures. So that is where we are right now. And if we have to, consider 7% decline from the top, so that would roughly mean around 1400 points of correction or so. And that would mean somewhere around 20,600 if I go by the average correction that we have seen. Right. Now, this was one data point. Okay. Now, in fact, when you also see the AD ratio, that is starting to decline as well. You can see that the 20-day average, that has been declining. And ideally, I think only when it goes to this level or probably this level, that's where we'll have to see if the market is bottoming out or no. Because, in this phase also, you can see that around this low only, I mean, around this low, the ratio had come towards the oversold line. Okay. But what happened then was that there was bouts of pullback in between, and it was correcting and it was making lower high, lower lows, and the ratio continued to remain in the oversold zone. Okay. Something of this sort cannot be ruled out over here as well. Okay. So that's where I think, the way DI is positioning is and the way the ratio is collapsing, it is telling you that the market is going higher on a not so good breath. And that I will also show it with the other diffusion indicator, which is again confirming the same thing. In fact, when you also go to the 40-day advanced AD ratio, even that seems to be dipping now. Now this is more of a medium term sort of indicator, right? We saw a peak over here, basically, which was this peak. Okay. After that, the market did keep rising higher, but there was a divergence as well. Okay. And eventually we saw this correction. Now, if you see, it peaked somewhere around this zone. Okay. There has been a fair sort of, movement on the upside, or you can say the sideways movement. And due to which now you can see that in this sideways movement, the breadth is actually collapsing, which means that the internals of the market are not that great. And the advanced decline ratio declining means that there are fewer stocks which are participating on the upside. Okay, and that is, it calls for an impending correction, like you see over here as well. Okay, there was a correction, and in this up move, the breadth did not recover at all, and eventually we saw a very big correction. Okay, so something around this around this line is what is going to happen. I feel it is just a matter of time. Okay, it is not like कि ये होगा कि नहीं होगा. It is like when does it happen? Okay, so that's where I mean, that is the phase that we are in now. Like I told you, there are many other diffusion indicators which are also pointing out towards the similar thing, and that is if you see the percentage of stock below the 20-day average. Okay, I mean, that is sorry, this is about 20-day average, and you can see that this is continuously declining. Okay, which means again the breadth is not so great. So while the Nifty index is probably holding higher, okay, but internally the internals are not good, because only 56% of the stock right now is above the 20-day average. And in fact, when you see that for the total market, okay, total market is nothing but a constituent of 750 stocks. When you see over there, it is even worse. I mean, over here, in fact, it has barely corrected from its top. It is almost nearby its top, but only 43% is trading above the 20-day average. Okay. And now, even if you see the other bigger averages like 50-day and all, so far they were resilient, but even they are collapsing now. Okay, you can see the percentage of stock above 50-day that is going down for the total market. You see the percentage of stock about 100, even that is coming down and cooling off significantly. Okay, these are all medium term indicators, and it will take some time to roll over. But when it does, I mean, it usually leads to a sharper correction. In fact, even in 200 DMA, I mean, it is now correcting, which means that there are actually, while the market say is at around the all-time high, but there are almost 23% of the stocks which are above 200 DMA. So imagine that the market being at the highs and 23% of the stocks are below the 200 DMA. So that also calls for some sort of weakness. Now, like I said earlier as well, in all these things, what we need is a confirmation. Okay. these are all indicators which are hinting you and giving you red flags. All you need is a confirmation. And for the confirmation, like we said, the 40-day exponential average, which was the blue line, that needs to be broken on the downside. Once that breaks, that's where the momentum will start picking up. In fact, when you see 1 month new high, okay, what it tells you is कि जो भी stock which are making new highs in 1 month time frame, okay, that number basically we have smoothened with the 9-day average. Okay, so you can see that the Nifty is rising high. I mean, the total market is rising higher. Okay, but the number of stocks making newer highs is actually declining. Okay,
Right.
that is again telling you that the market is rising higher on a narrow breadth. I mean, the breadth is cooling off, significantly. And this is not just true for the total market index, but you see anywhere. I mean, it is the small cap index. You see a similar thing. In fact, it is worst over here. I mean, it is not even recovering when the pullback that we have saw. I mean, we have seen this pullback in small mid caps, but this ratio is not recovering. In fact, this is for the mid cap as well. Okay, you can see even in mid cap this is happening. So imagine that over here the reading of 35 was there. When the market was rising higher, but now when the market is rising higher, only 19 ka reading is there, which is telling you that again the breadth is getting narrower and narrower. Okay, now ultimately when there is a reversal, okay, that's where I think things will get worse, and the momentum on the downside will pick up. But yes, broadly, if you see, these are all indicators that are pointing out towards some bit of caution that we need to maintain. And it's basically like I mentioned, the way, I mean, once the averages break on the downside, that is the 40-day exponential average, that's where the decline can kick in. And you see all these indices are sitting at that point. Okay, so we could be in for a volatility or a correction as well. Okay, and that's where one needs to be very cautious. And actually once the 40-day breaks, that's where I think the bullish bet should be off, and we should brace ourselves for a correction in the days to come.
Just give me 2 seconds, Jim.
Yeah.
Just started watering so much, I couldn't do it.
No, it's okay.
Don't worry, I got this done. You finished, no?
Yes.
Okay. Okay. 1, 2, 3, start. That was a very fruitful midweek, Jay. Thank you so much for your analysis. I would also like to inform our viewers about the free webinar that we are holding this Sunday. So we have a free webinar this Sunday, guys. It's on the 18th of February at 10 a.m. And our speakers are Mr. Rohit Srivastava himself and Mr. Gaurav Chopra. What you will learn from the webinar is basically it's a webinar on sector valuation, and you will get to know more about how to use the RMI, that is the Rohit Momentum Indicator, our proprietary indicator, how to understanding valuation better, combining RMI and valuation, and also more about sectors that are presently overvalued and also are undervalued. So we will send you, we'll have a link down on the description. It's a free webinar, okay? So book your seats as early as possible. As usual, I will always leave a link to Strike. You get a 7-day free trial, and also follow Strike and Indiacharts on YouTube and Twitter. The links will be down in the description. Thank you very much for giving us your time, guys. And Jay, thank you more for giving us your time and analysis. Take care. Thank you so much.